Well, good afternoon, everyone, and welcome to our weekly webinar where we're going to talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our investment strategy. We're broadcasting live a little earlier today on account of the 4:07 p.m. start for the Blue Jays Royals game number 4. We are recording this webinar so that those who can't join us live can tune in when it is more convenient, hopefully following a Blue Jays victory. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, founder of High Rock, and our financial planner, Bianca Tomlinson. Now, we'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions today if we don't have any time, because we're bumping into Blue Jay start time, so you'll understand why we move through that very quickly. Based on some great feedback from our listeners, we've made some adjustments to the format of our weekly call. So if you're a first-time listener and would like a little more information about our private client services and our philosophy of transparency, we have a separate webinar that will provide you with this on our website, just adjacent to this weekly webinar. Well, each week I like to review what has been the top trending Google searches this week. No surprise, the Blue Jays, Elections Canada, we all know what happened there, Lamar Odom's brothel breakdown, the Lotto 649 record 64 million jackpot, and Canadian boxer David Lemieux's fight. Once again, nothing has resonated with searchers on the financial markets front. However, if you did win the Lotto 649, we may have a few ideas for you. So Canadians wanted change. Voter turnout was 68%, one of the highest measures since 1993. This was the last time the Canadians voted for a significant change, according to those preliminary numbers from Elections Canada. So now there's going to be a whole new political team in place, and they're coming to power at a very complex time for the global economy. We may learn more about who the key cabinet ministers will be later today, but it is estimated that proposed infrastructure spending by the Liberals in their campaign promises will add from 2 to 0.5% to Canadian GDP. The initial financial market response, I saw some buying on the TSX this morning, pushing it up over 100 points. It's settled back slightly lower since then. The Canadian dollar has been very little changed to ever so slightly stronger. From a personal finance perspective,
Scott, I was going to say you should probably add that Government of Canada bonds have been hit quite hard, I think, on the back of a Liberal majority, with the expectation of a few years of budget deficits as well.
That's a good point. Thank you, Paul. Appreciate that. I was just going to talk from a personal finance perspective. While nothing is yet been done and won't be for we expect for a little while, but we do expect that the Liberals will follow through with their desire to reduce the annual TFSA contributions. They'll curtail family income splitting, but that won't change the pension income splitting situation. But they will also create a new tax bracket for those individuals who earn over $200,000 per year. The federal tax rate on that will be 33%, and that's up from the highest tax bracket now, which is 29%. So high-income earners are going to be smacked pretty hard in this situation, as well as government bonds. As I said, the recent strength of the Canadian dollar has not been impacted significantly by the election. But while we're on Canada, let's talk a little bit about last week's economic data. Manufacturing sales edged down 0.2% in August, following 3 consecutive monthly advances. The largest declines were recorded in the petroleum and coal product, in the motor vehicle parts and aerospace product industries. However, these declines were largely offset by gains in motor vehicle assembly and wood product industries. In other news, August's Canadian wholesale sales edged down 0.1%, while inventories actually rose 0.6%. That takes the inventory to sales ratio from 1.32 in July to 1.33 in August. The inventory to sales ratio is a measure of the time in months required to exhaust inventories if sales were to remain at their current level. A strengthening economy would be characterized by declining inventory to sales ratio. In this case, we saw a slightly increasing inventory to sales ratio. South of the border, the industrial sector of the U.S., specifically the manufacturing sector, continues to struggle, largely the result of weak exports. Inflation data showed continued subdued inflation readings, and retail sales continued to trend lower. On a more positive note, the U.S. fiscal deficit shrank to levels not seen since 2007 on the back of higher tax revenues. Also positive, housing starts, as announced today, increased by 6.5%. So how did financial markets react last week? Well, volatility continues to decline with the lack of any earth-shattering news and has moved back below its 200-day moving average. However, the U.S. government will exhaust its emergency cash management measures by November 3rd, and there are risks that they may run out of cash shortly thereafter if the federal borrowing limit is not raised by Congress. Now, this has pushed the yield on one-month T-bills up from 0% to 0.15%. Likely this is just more political wrangling, but always worrisome if the U.S. cannot pay its bills. Farther out the yield curve, the U.S. 10-year government bond yields are trading in a relatively narrow range between the recent lows of 1.9% and recent highs of around 2.15%. For the moment, we don't see any real catalysts to push it outside of that range. However, the trend to lower yields may require a test of the 1.9% bottom of the range next. Of course, this will depend on the economic news that continues to roll in from week to week. And at the moment, there's nothing new or definitive on that front. Equity markets were a little higher as participants weighed the expectations of what slower than expected economic data means, a longer time frame for low interest rates offset by lower earnings expectations. We'll talk a little bit more about earnings later in the call, but our concern is that lower interest rates remain a panacea for equity markets, encouraging short-term buying. For us, this is like pulling an elastic band too far. We are worried about the snapback effect. Now, we are close to a test of that red downtrend line that began back in May, which crosses near the 2040 level on the S&P 500. Now, how the market responds to that test will give us some further understanding of the short-term psychology of the market. A break to the upside may encourage buyers, but otherwise, a break to the downside would likely encourage sellers. Currently, the markets are focused on very short-term factors. Economic data and earnings announcements will continue to dominate the news wires, and traders will find encouragement or discouragement from that news. Just a reminder to all of our listeners that we at HIROC are always aware of what is driving the short-term trends, but we also have to be guided by the medium and long-term fundamentals. At the moment, our medium and long-term outlooks remain highly uncertain, and it is our wish to continue to be more worried about protecting our capital than to be worried about growing it. Commodity prices this week have pretty much moved sideways, and that's been pretty much the case for the last few weeks, actually. Around the global economy, well, in the Eurozone, industrial production shrank and inflation fell back below zero. However, core inflation remained unchanged at 0.9%. Meanwhile, minutes from the latest monetary policy meeting of the European Central Bank showed policymakers expect the euro area economy to recover at a slower than expected pace, hurt by the slowdown in China and emerging markets. Although they're not sure about the severity of the impact, GDP growth projections for the euro area have been lowered to 1.4% for 2015, 1.7% for 2016, and 1.8% for 2017. Chinese GDP expanded on a quarter seasonally adjusted 1.8% in the third quarter of 2015. Annualized, that's a 6.9% rate, which is down slightly from the 7% expansion in the previous quarter. It's the slowest growth since the first quarter of 2009, mainly due to a slowdown in industrial output, sluggish property investment, and a contraction in exports. As for the Bank of Japan, they kept monetary policy unchanged. Policymakers there said the economy has continued to recover moderately, though exports and production have been affected by slowdown in the emerging economies. The Bank of England left rates steady as expected. Policymakers there now expect a softer outlook for inflation and growth, and showed concerns that global economic and financial developments may restrain economic activity. So in general, we're still seeing expectations for slower than initially thought there would be global economic growth. And we're also seeing the impact of that slower than expected growth on the U.S. economy, the U.S. Export economy being significantly hit by virtue of the slower global economic situation. Okay, so what do we see coming down the road? Well, let's turn to bond markets, because we always look to bond markets to give us some ideas of what is anticipated on that front. Bond markets tend to lead other financial markets. If we compare various country yield curves with time to maturity along the horizontal axis and yield on the vertical axis, U.S. 10-year government yields, the highest, are just a little over 2%. The positive sloping curves and the higher long-term yields for the U.S., the UK, and Canada indicate that expectations in the bond market are for mildly improving economies and slightly improving inflation scenarios farther along. In the short term, however, there are greater uncertainties. The U.S. 3-month yields are at 0%, which anticipates no rate increase, at least for this year. German bond yields out to 5 years remain below 0 and indicate continued struggles for the euro economy. The same can be said for the Japanese economy as well. Our high yield bond indicator remains low relative to the S&P 500, but the divergence is not as significant as it was, and at the moment doesn't really give us any substantial clues of what is coming. We'll keep our eyes on that situation as well there. Well, we still think equity markets are expensive, and in fact in the last few weeks they've gotten more expensive. The rally 2.5 weeks ago made them that way. As I said earlier, all indications are that we may not see a Fed increase this year. Investors and traders who borrow to buy equity assets are relieved. And that has been the catalyst for the jump in equity prices recently. However, over time, the fundamentals are really going to be the focus. So let's look at the fundamentals. The 10-year average price-to-earnings ratio is at 14.1. Currently, the forward 12-month average is at 16. Last week at this time, it was at 15.9. And in May earlier this year, it peaked at 17. So still showing that stocks on a relative basis are expensive. We are now at the beginning of the third quarter earnings announcement season. Of the 58 companies that have reported earnings to date for this quarter, or for the third quarter, 81% have actually reported earnings above the mean estimate, and 50% have reported sales above the mean estimate. For the third quarter of 2015, the blended earnings decline is 4.6%. Now, at September 30th, the estimated earnings decline for the third quarter was 5.1%, so it's slightly improved to negative 4.6%. 6 sectors have higher growth rates today due to upside earnings surprises, and that's been led by the industrial sector. For all of 2015, analysts are now projecting earnings to grow by just 0.2%, but revenues likely to decline by over 2.5%. In our other metric that we like to look at, the enterprise value to earnings, S&P 500 companies are valued at current market prices at 12.25 times, up from 12 last week. The 10-year average is 10.4 times. And as Paul has mentioned on previous calls, in our tactical growth model, we're not much interested in anything with a valuation of anything over 8.5 times. Well, each week we monitor margin debt, which traditionally has been another leading indicator of equity price movement. Investors who borrow or use leverage to buy equities are fine as long as returns are greater than the cost of borrowing. When asset prices drop, lenders either want more margin or they want the borrowers to pay down their debt, which means that the borrowers need to raise cash. Well, they do this by selling assets. In some cases, they sell the most profitable assets, some cases the most liquid assets, but this selling increases volatility and uncertainty. Historically, a decline in margin debt, as we saw in 2007, 2008, leads equity prices lower. After record levels of margin debt earlier this year, we could be seeing similar margin-related equity selling beginning. Now, on this note, let's look a little bit at what concerns Paul and I about the low interest rate environment that we've been in for the last 6.5 years. Low interest rates initially provide an incentive to borrow to invest in future growth. However, this can be at the risk of potential further growth beyond that. Now, for example, in the early 1980s, $4 of debt was needed to generate $1 of additional GDP growth. Now, in the 2000s, $10 of debt was needed to generate $1 of additional GDP. And now, $20 is required to generate an additional dollar of GDP. So ultimately, debt becomes a less effective tool. And with low interest rates, global indebtedness has grown threefold over the last 10 years. Now, worse, when asset prices begin to lose value or deflate, or when interest rates rise and debt becomes too expensive, it requires asset sales to reduce the debt. Now, central banks fear this situation potentially spiraling out of control. Paul, did you have anything you wanted to add here?
Sorry, Scott. Well, I was going to ask you a question. What exactly is the plan of the new Liberal government now spending $25 billion over 3 years to run deficits? Now, if we look at it, roughly $25 billion back in the 1980s, it would have only taken them, $4, $5, $6 billion to get an additional dollar of GDP. So, yeah, it's going to be problematic. I think the whole world is awash in debt, structural debt at every level of government, corporate debt, personal debt, and quite frankly, interest rates just can't go up a whole bunch given the structure of the debt. But what it does, and you've laid it out very well here, is it really puts a stranglehold on growth. So we are in the camp of we're in a much lower growth environment than we have been in previous cycles.
And back to your Canadian situation, and that's a really good point, because the deficits that were created back in the 1980s and early 1990s that eventually were brought back into balance throughout the late 90s and then again more recently, that borrowing had a much more significant impact on GDP. It's going to be interesting to see how the Liberals will propose to, if they're going to increase deficit spending now, as we've uncovered here, or as we've explained, with higher deficits and getting less out of those deficits for the GDP, and then what is the eventual cost of having to bring that deficit back into balance. So, or that budget back into balance. So maybe it's not the best time for the Liberals to be going on a spending rampage. Unfortunately, that's not anything that was pointed out to Canadians in general prior to the election. Okay, so just to sum that up, we are, as we have been saying often, in a low return environment, but that makes debt even more worrisome because there's so much outstanding debt, and the growth being generated from that debt is so low, it basically makes that debt redundant and maybe doesn't even justify the cost of having that debt. So we think that borrowing to invest, certainly at this point in time in the cycle, may not be prudent. As always, our focus is on getting good risk-adjusted returns for our clients and ourselves, and not be driven to chasing higher returns at the expense of adding risk to portfolios. At High Rock, we use 3 investment models. I talk about these regularly. I'll be a little bit more brief this week, with which we build our balanced portfolios. Our fixed income model is comprised of 4 sub-asset classes: government bonds, corporate investment grade bonds, high yield bonds, and some preferred shares. We've actually noticed that there has been a significantly large amount of new issuance in the preferred share markets. We do actually anticipate that there may be more to come. We have, as a result, begun to reduce a little bit of our holdings in preferred shares even further than we had before. Based on this, also we do expect some tax loss selling as we move into year end. So we think it's prudent to lower our weightings of preferred shares at this particular point in time, and then look for opportunities a little farther along down the road with which perhaps to get back in at cheaper prices.
And Scott, we could probably also add, we are looking to sell some preferred shares in the hopes that we can buy them back cheaper, but also we've redeployed the cash into some corporate investment grade bonds, which are up on the screen. And this is one of the key benefits for our clients and ourselves to have our money at High Rock. As we've always said, fixed income is our real wheelhouse. So just as an example, we bought 4 investment grade bonds yesterday for all of our clients, all at the same price, and ourselves. We all got filled, and those prices were at an institutional price, or on the screws market pricing, where huge millions, tens and hundreds of millions of dollars trade a day. We were able to go buy our small measly amount at the exact same price. And that, at the end of the year, is really going to add up in our return column. Just the price execution that we get. And also, I would add that those corporate investment grade bonds, we feel like that's, given our defensive posture, a reasonably good risk-adjusted return for us right now.
One of the things we've often said to clients or prospective clients is that the institutional side of High Rock offers us some advantages with regards to getting this kind of wholesale pricing that we can get for our clients and ourselves. So that, as you've just explained, Paul, is one of those advantages, and those advantages over time do add up and also add to the bottom line for our portfolios. Our global equity model, where our objective is broad diversity across many different geographical locations and economic sectors, where we buy mostly exchange-traded funds, but remember we're buying companies and not countries through those exchange-traded funds. We are also seeking to find the lowest cost ETFs as possible. From time to time, we'll own some of these U.S. ETFs in U.S. dollars or have cash in U.S. dollars, because when the world gets volatile, the U.S. dollar is a safe haven, and this can drive the value of the U.S. dollar higher, which helps to reduce the impact of volatility on a portfolio. Our third model is made up of usually small to mid-sized Canadian companies that we believe, through our in-depth research, may have outstanding growth potential. This could hold anywhere up to 10 names and may in fact hold U.S. companies as well if we see the potential value of doing so. At the moment, we own 3 companies in this model, and the balance is in cash. And Paul, I don't know if you've got any updates for us on this.
Yeah, just very briefly, one of the companies that we own was acquired. The acquisition has not gone through yet. It was acquired by another company that we were looking to buy stock in. It's a little bit complicated, but the acquiring company is buying the target company that we own the stock in for all stock, no cash. So we're going to end up with stock in the acquiring company, which we wanted to buy anyway, but we're going to be buying it at a substantial discount to where it's trading in the marketplace today, should this acquisition go through sometime in the first half of 2016. So we've got some embedded gains in there that's trading at a fairly steep 20% discount right now. So the stock we own should provide us a really good return here on this acquisition sometime over the first half of 2016. I was supposed to meet with the acquiring company, have a one-on-one meeting with them on Thursday at a conference, myself and a couple friends, but they canceled all their one-on-one meetings that day, unfortunately. So I don't have any more intel, and I'm not really at liberty to say much more, but that was it should be a good trade for us.
So as I've continually mentioned, client portfolios are created based on client goals, their objectives, and their risk tolerances. And of course, we use the wealth forecast that helps for us to strategically create these different portfolios for our clients. Just as a note, clients should have all got their third quarter package with the performance, the investment review committee's update, and a little note from us as to how we've been and why we've been positioning ourselves the way we have. But I do want to make sure that any client who is in need of any further communication or would like to have a review of any sort, that they definitely get in touch with us to discuss their portfolios and to discuss any issues or concerns that they might have after receiving these third quarter reports. As Paul and I like to do, we like to be transparent about what we're doing, and each week we show you what our portfolio composition is in the context of our models. My portfolio is 50% global equity and 10% growth, which gives it that 60% overall growth or equity, and then the balance is the fixed income. Paul is a little bit more growth oriented in his portfolio, but he balances that with a little bit more fixed income. So portfolios can be constructed in many different combinations, and really, again, it's just a function of what strategy best suits each individual client. We like balance because our research says that balance over longer periods of time can and will get better risk-adjusted returns than simply owning an equity index. And you can see how risk or how much lower risk there is in the balance model versus some of those index equity indices. Okay, well, every week I like to do a little bit of a look back on what's going on with parts of our portfolios. So how do we compare performance after the last week? As I often say, the portfolio that I have has about an exposure of 18% in the U.S. equity markets. So the S&P 500, as a representative of the U.S. equity market, was up 1% since last week, and is now down about 1.2% on the course of the year. Canadian companies are about 9% of the model, and the S&P TSX was unchanged this week, down 6% on the year. Euro area companies, about 4% of that model we're down. We're up 1% on the week and are currently up about 4% on the year. The Japanese companies, about 3% of that portfolio. This week unchanged, year to date plus 4%. UK companies, about 2.5% of that model. The portfolio. The FTSE 100 unchanged on the week, down about 3% on the year. And Australian companies, less than 1% of the portfolio. The Australian All Ordinaries Index was up 1% this week, but is down 1.6% on the year. We also have to China and emerging markets, and this week China's Shanghai Composite was up 4% and is up 4.8% on the year. The emerging markets ETF that we buy for our model is basically unchanged on the year. So by comparison, the 60/40 model that I use or the combination of models in my 60/40 portfolio is up just a little over 2% so far this year. Okay, that's it for today's discussion. If anyone might have a question, please feel free to ask it now. All right, I guess everybody wants to get to the Blue Jay game, so I'm not going to hold anybody back. If you do have questions and wish to email us, we would be more than happy for you to send them. We'd love to get your feedback for these webinars. Anything that you think you'd like to see or have us talk about, please don't hesitate to send to us by email or give us a call. But that's it for another week. Thanks for taking the time to tune in. Have a great rest of the week, a good weekend, and go Blue Jays. And we'll be back with another report next Tuesday. This is Scott Tomlinson signing off.